The OCR is at 5.5%, inflation is at 6%. The housing market, I think, in some regions has dropped 20% from its post-COVID peak. China's rebound has been slower than many hoped. The war in Ukraine grinds on. As we all know, and as the Finance Minister acknowledged this morning, this is a challenging time for New Zealand's economy and the global economy at large. Still, there are some potential slivers of optimism. Unemployment is still low, and we are yet to see a tidal wave of mortgage defaults in New Zealand. Our Chief Economist session is an opportunity to dig into the data a bit more to better inform our collective sense of direction. Mark Lister, who was hoping to be here today, is actually unwell. He's woken up unwell this morning, so he can't be here, but we have an all-star panel. Crampton, who's the Chief Economist for the New Zealand Initiative, and Jarrod Kerr, who's Kiwibank's Chief Economist. Please join me in welcoming them. So the MPS, the Monetary Policy Statement, is released in about 2 hours' time. Jarrod, this is your ballpark. What are you expecting?
I'm expecting the central bank to be on hold. Keep the cash rate at 5.5 for a while yet. Monetary policy is still working its way through the economy. As a bank, we've got 40% of our mortgages coming up for renewal in the next 6 months. So the impact of rate rises so far are still being felt in the economy. I think the central bank's done enough. They can sit back, and I think actually the next move might be a rate cut, but not until 2024.
We'll get into Eric's thoughts in a moment. 40% in the next 6 months, you said, of mortgages. So that is the lag that we're expecting when it comes to the OCR, right?
So the first half of our mortgage book rolled off, late last year and into this year, and we already saw a contraction in economic activity on the back of that. The other half is rolling off as we speak with some lumpy stuff in spring and summer, because that's when the activity takes place in resi, and that increase in interest expense is being felt by households.
Resi.
Residential.
Yeah, I get it. I just haven't heard that term before. Eric, what are you expecting this afternoon? What would you like to see this afternoon?
I expect about the same. I still worry, though, because inflation expectations are still way higher than you'd want. 1 year ahead is still something like 4.8, and 2 year ahead is just barely below the 3% target. If you look at Canada, they've already come down below 3% last month, and they're just barely above 3% this month. So they've got it back in check. Inflation expectations in the US are coming back in line. A Taylor rule here would say we should have interest rates somewhere around 8%, and it's a worry, right? We've had the exchange rate tanking. That will put more pressure on inflation again with tradables coming through. Normally, we get a bit of reprieve because everybody else in the world does their job. That makes tradable things for us cheaper, so that keeps our domestic high levels of inflation in check. Well, and a tanking exchange rate doesn't really help with that. So that would have stronger case for the Reserve Bank to be doing something, but they'll be terrified on the milk prices.
Right. Yeah, talk to us about that.
Well, tanking milk prices will flow through into everything.
Yeah.
It'll hit the government's accounts. It'll hit consumer spend as it ratchets all the way through. Right? The farms clamp down. Small towns clamp down. They buy stuff from the cities. That clamps down. That will all work its way through, but the Reserve Bank still just has its one big job, and according to the inflation expectations estimates, they're not quite on top of it yet.
Right. Hey, I want to cast our mind back to this time last year, and it wasn't quite this time last year. I think we had the conference last year in September. So I looked up the big bank's forecast for the OCR in September of last year. 4.75 was the expectation for the peak. We're currently at 5.5. You think arguably it should be higher. Talk to us about what has changed in the last 11 months or so.
Well, I'll pass on to the data stuff to the guy who actually works with it all the time. But just generally speaking, it's felt a lot more like a holding pattern. We've had employment rates that are at or near historic highs all the way through this. We've had continued high levels of government spending. So while the fiscal impulse, you'd say, is lower because they're spending less than they had a year ago, it's still substantial deficits while the government, or while the Reserve Bank is trying to get inflation rates down. So it's adding pressure there still, even though it's less pressure than it had been. I don't think this time last year we would have been expecting that we still would be at 6% inflation. You would have hoped that things would have gone harder. We haven't hit that yet.
Yeah.
So I think last time we were all expecting a pretty sharp Reserve Bank response, that we would have fairly severe levels of unemployment as a consequence. None of that has really panned out yet because it's taken longer for that to flow through. Perhaps the natural rate of interest is a lot higher than we'd the interest rate that you might need to get this in check might be higher than they've been expecting, or that we'd been expecting last year.
I'll talk about government response in a moment. So, Jarrod, you got something to say there?
Yeah, I was just going to say it's also a matter of timing, though, right? Because it's all still feeding through. So if I think back, this time last year, we definitely didn't have inflation rates as high as they are in our forecasts. We thought the Reserve Bank would be finished at 5. We got this extra 50 basis points, basically on the back of an inflation outlook that was deteriorating. But since then, like today, the sands have shifted. We've seen quite a substantial shift in business behaviour. The discussions we're having with our clients have changed dramatically over the last year. Last year, it was all about trying to meet sales, trying to get staff, which was the big problem. Now, actually, it's their order book. It's their future revenue that they're worried about. And this spike in migrations definitely helped the labour side of things. But that business mindset really has changed. That they're less willing to invest. They're less willing to push the boat out.
Is that a necessary change if taming inflation is the goal?
Exactly, and that's what the Reserve Bank wants to do, right? You take an interest rate from a level that was far too low, far too accommodative, and you put it up to somewhere that is no longer accommodative and actually restrictive. So yes, it's having that desired impact, which is why I think they just need to wait and see that come through.
What do you make of the state of the growing deficit?
Well, it's going to reverse, right? So we've got a very bad current account deficit right now. Most of it's on the back of trade. We came out of COVID, guns blazing. We were overstimulated. We had way too much government spending, way too much stimulus from the central bank, and that was like putting out fire with gasoline. Like, we really just took off, and we saw this massive demand spike. So our trade deficit is bad, and Eric will probably talk in more detail. But given the slowdown in the economy, given what we think imports are likely to do relative to imports, we do actually see it, going from about 8.5% of GDP down to sort of 6% and lower over the forecast horizon.
Eric, let's get on to the fiscal response.
Sure.
Yeah. COVID came around, and I know that if the finance minister was sitting here right now, he'd say, yep, we made promises going into the 2020 election, but then we got hit by Omicron, we got hit by Delta, we had these unexpected blips in the road with COVID that meant we had to spend more than we needed to spend. But what do you make of the fiscal response so far?
Okay, if we go back to March 2020, I can't fault anything, right? So they did go harder on fiscal response than you might have hoped, but there was a lot of uncertainty. They should have changed course a little bit faster, but they got a lot of things right at that point. But if you look at the budget from 2019, so before COVID, so they put through basically their expectations of what government spending is going to look like as a proportion of overall economic activity. So their forecast in 2019, before COVID, for 2023 was that core crown expenditure was going to be 28.8% of GDP. So you will get this huge surge during COVID. That hadn't been forecast yet. Nobody in May 2019 was expecting COVID. But you'd think that by now, the effect of that would have washed through, right? They would have retrenched all of the spending that they had to do on tests and everything else. That's come down. Well, if you look now at the budget update this year, core crown expenditure was 32.5% of GDP. So they've increased by about $14.25 billion relative to what they were saying they were going to be spending in 2019 for this year. So just as a fraction of GDP, so we can ignore inflation, they're spending massively more now than they had projected in 2019, and COVID's run through. That's not really affecting government spend anymore, or to the extent that it is, it's stupid that it is. If they're still doing stuff like enviro jobs to try and prop up tourism, well, that's a horrible mistake, right? So they're spending about 11% more than they had forecast. On the revenues, people talk about the deficit, oh, what are you going to do to increase taxes and get more tax for the government? Well, they were projecting in 2019 that core crown tax revenue would be 28.8% of GDP. Actual, as of budget 2023, was 30.4. So they've raised an awful lot more money in tax, largely because they failed to inflation adjust the tax thresholds. So poor people pay an awful lot more in tax. And we're still in a substantial deficit. They were projecting a return to surplus for 2026, but that's certainly not going to happen. It was wrong when they projected it at budget because they forgot about tobacco excise, and I can get into that later if you want. But it's also wrong because economic conditions have soured since.
Right. But just to play devil's advocate, imagine
Sure.
if the finance minister was here for a moment. He would say that the continued level of response to COVID, first of all, that COVID has a long tail, but that this is the cost of keeping unemployment at 3.4, 3.6% like it is now.
Well, I'm not sure that the government should be trying to target employment rates that are the highest that they've been in the entire data series. Like you go into the, check for yourself, go to InfoShare, Household Labor Force Survey, quarterly data. The employment rate currently, or for the past year, has been higher than basically it's ever been in that data. All right? It's overheated. It's wonderful that people have jobs. That's all great. But it's artificially high, right? You want to pull back that stimulus. That's the kind of thing that you do in a bad recession when you're trying to come up with make-work schemes. You don't run make-work schemes when you've got overemployment. And they're still doing it.
So what do you do about the deficits now? If you were in charge, what would happen?
Pare spending back down. Okay, some of this gets to kind of a values question. I want to try and abstract from that. Labor on the policy platform it set out in 2019 and then through the election, spending is an awful lot higher than what they had been putting up. Retrenching back down to what they were expecting from 2019 would be a pretty good start. And also trying to get back to some measures of effectiveness in spending. That would be pretty useful. Now, they could argue the toss about, well, increasing the size of government further, backed by, well, inflation adjusting the tax thresholds and maybe taxing a bit more at the top. You can make a values case on that. On the national side, you'd be absolutely wanting to retrench spending down to what Labour had been expecting in 2019, or perhaps lower than that. Absolutely readjusting the income tax threshold so we're not sticking median wage earners on very high income tax rates, and absolutely getting back to the kind of investment approach focus that had strong measures of cost effectiveness and spend.
I know there are limited things you can say on this when it comes to the political front, Jarrod, but are there obvious things that you think we should be considering when addressing the scale and period for which we're expecting deficits?
Yeah, see, for me, it's the future that we don't spend enough time on, right? It is an absolute disgrace in this country, our infrastructure. Our infrastructure has been underinvested in for decades. It is an absolute disgrace, and we're not addressing it, and we're importing a lot of people again. We had the largest migration boom in New Zealand's recorded history between 2014 and 2019. We didn't build for it. We've now had 100,000 people come in the last year. We're not building for it. The problems that we face just get worse the further you project out. We have an ageing population, right? We're not having a proper discussion around how we fund that. Do we need to do what most other countries are doing, including the Aussies, and lift the retirement age, or do we need to means test stuff? All of this is going to come to a head, but I'm sick of governments coming in and I'm asking them the question and they turn around and say, we're not set up to answer that question. And I'm like, well, you could be in power for 9 years. That's 9 years, of which you're kicking a can down a road.
Yeah. Completely. And on infrastructure funding and financing, it's a bit depressing in the election campaign, right? You have people promising to throw massive amounts of money at these things, but there's no testing of demand. There's no serious cost-benefit assessment on the roading infrastructure. What you really need is a system that it goes back to basically a user pays system that we once had, right? You want road user charges to be able to cover the cost of the roads over time, including their construction and maintenance. If you keep subverting that with roads of national significance or non-user pay tunnels under Auckland Harbour, it's a recipe for disaster.
Let me pick up on that. There's a question from the floor here that kind of hits on a point you're both making. How do you reconcile needing to reduce spending with the infrastructure deficit, given the size of the infrastructure deficit? I think more than $200 billion. And I appreciate there's a CapEx, OpEx division here, but is there a risk that in trying to address that deficit, it's inflationary?
Okay. So it'd be it depends how you set it up. So I've recently done a little bit of work looking at infrastructure funding and financing and looking back to how New Zealand used to fund and finance these things. So this is just remarkable. A century ago, we were smart about this, and we've just forgotten how to do it. So under the Local Government Loans Act, Local Bodies Loans Act 1913, a local council could have a referendum of the local ratepayers, see if they wanted a project that was for the benefit of the community. They'd publicize it. If the ratepayers said, yeah, we want these improved roads, we want these improved sewers, we want a town hall, whatever, if they pass it by ballot, then local council could issue debt over decades to pay the thing off, right? You had ratepayers authorizing the project saying, yes, we are happy to have a special levy on our properties to pay this debt off over decades. Because, like, why would you try paying it off on a short term, right? You don't have a one-year house mortgage. You have a very long-term house mortgage. And while infrastructure is even longer lived, right? Or at least some of it, you structure it over time. And we've forgotten how to do that. If we go back to those kinds of ratepayer authorization structures so that ratepayers could say no if councils want to spend money on dumb stuff, but say yes for projects that actually add value and spread the cost of it over time, that's like a separate, like I was talking about core crown expenses, core crown revenue. This is an entirely different bucket, right? You say, okay, this is how much I already know how much I'm paying in tax. I'm happy to pay this much more as a levy on my house to be able to get nice stuff that improves my property value, whatever. Pay it off over time. We totally could do this again. There's a kind of a structure for it in the infrastructure funding and financing model, but well, getting back to some of the earlier stuff on financial markets reg, we can't do the kind of things that we were doing in 1913 because we've made it atrociously expensive to issue new securities, right? So back then, you could have long-term debt for something as small as the Nio Town Hall. It cost something like £10,000 at the time. And now it costs you $500,000 even to even get a structure for a listing, right? You can't fund and finance these little community things out of it. It all winds up being these large projects, and they don't have the ratepayer authorization mechanism around it.
Yeah. Okay, I want to pick up on. Oh, yeah.
Yeah, sorry. I agree. Right. You know, I've been an interest rate strategist for most of my career. Right. Being a chief economist is nowhere near as much fun. So I love debt, and I've been selling government debt effectively, Australian and New Zealand government bonds, for 15 years, and that involves going around talking to investors, central banks, sovereign wealth funds, insurance, you know, ACC, these sorts of characters. There's not enough New Zealand debt out there. We have very low levels of debt, government debt. Councils up to the eyeballs. Government, not much at all. Our net debt, as a percentage of GDP, 20%.
I'll have one caution on that once you.
Yeah, well, I'm just, you know, relative to peers and how international investors invest. They like starting off at AAA, you know, AA plus. We're in that top echelon of countries globally. We're in there with, you know, Luxembourg and Singapore and a bunch of countries you can't even find on a map. And then you go down to those who have been downgraded, like the United States and the UK and the others who actually have the big liquid markets. You know, we are playing in that space. We are attracting central banks, sovereign wealth funds from around the world to buy our debt. DMO issued a bond the other day. I think they took $4 billion and there was $13 billion offered. Plenty of demand for our bonds and at really low rates.
Cool. The caveat that I would have on this is, well, it depends what you mean by the debt, right? So the kinds of ring-fenced debt vehicles that I was talking about where ratepayers have said we want this, or say that it's a roading project where you set a toll on the road, the toll pays off the debt over time. I don't care whether it's a private provider that's running it or NZTA. They've got a toll on the thing. It pays off the special purpose debt. Issue as much debt in that form as the market wants, right? That finds its own level because you've got a cost effectiveness test in there. If the debt markets tell you that your project is not viable because the revenues coming from it aren't going to stack up, well, that's an automatic check on it. If you're talking about Crown main balance sheet debt, that I'm a lot more careful about because, well, we're a small country at the far end of the world subject to really weird shocks, and we're too small to spread it easily. So we wind up having to go to debt markets in those kinds of crises. Maintaining that headroom in case we have a recession that hits during a Wellington earthquake, it seems pretty important to me. But yeah, the ring-fence debt that's project-specific, yeah, let the market sort that out. Issue as much of it as makes sense.
We've only got 10 minutes, so I want to do some quick forecasting stuff. And Jarrod, I know this is your wheelhouse. What's the outlook for house prices?
Well, we'll decline for a little bit further, I think. I think we've yet to find that actual bottom, but we're pretty close. The discussions with our mobile mortgage managers, the brokers, confidence is turning. It's returning into the market, so we think we'll see a bottom. So we would have seen, maybe an 18%, correction from a very high peak back to somewhere still high. And then next year we're thinking house prices will be up about 5%. And there's a lot that goes into that. There's the supply versus demand. Demand has picked up with the surge in migration and population that we've got. Supply is starting to ease back a little bit. And I think what will be the key driver is that interest rates have peaked right now, and I think that's what's got people thinking, oh, okay, it's not going to get worse. And then you've got some economists like me saying, well, actually, why don't you start thinking about what's going to happen next? If that's the peak, there's another side, and there's rate cuts coming next year.
When do you think next year?
I think as early as February, maybe May next year. The central bank's telling us it's the second half of next year. That's a very long time from May to the second half of next year. May end up like that. I think the risk is that it actually, comes in earlier.
So what does a retail mortgage rate look like come Christmas 24?
24?
Yeah.
I would say at least, 150, 200 basis points lower than where we are today.
Right, in terms of the OCR, yeah.
Yeah.
That's significant. What is the impact of Ukraine in the ongoing war?
Yeah, good question. I mean, it had a big impact to start with. It's sort of tailing off at the moment. It depends, how it ends really, and if it ends, how those tensions play out. But the impact on Europe has been far less than we thought. They had a very mild winter. There was definitely an impact on commodity prices at the start, but they're all lower now.
Yeah.
So I think it's something that'll keep sort of festering in the background. I'm more worried about our own backyard. I'm more worried about China and other nations that we might be forced to face, and that's a very awkward situation where you've got this number one trading partner that we do so much with potentially having a conflict with the US. Really worries me. Yeah,
right. What would be the impact if things were, at the very least, if the tensions were to intensify further from the current point?
Well, depending on what we do and say, let's pretend we're Australia, and Australia seems to be more able to stand up. They can punish us, and they can say, well, we won't buy your dairy anymore, we won't do this, we won't do that, we certainly won't send our tourists. They've already done that to us before. I think it was in 2018, they threatened not to send the tourists here for 6 months, and that actually had an impact. So I'm worried about the economic warfare that could develop from that.
Eric?
Well, sure. New Zealand has done a remarkably good job in balancing between the U.S. and China, maintaining strong trade relations with China and strong diplomatic relations with the U.S. It just seems nonsense, right? The U.S. really wants to have a stronger Pacific partnership. They want to have, they talk about friend-shoring. They want to have diversion of trade away from China and among U.S. quasi-allies. And at the same time, they throw strategic tariffs against our steel and aluminium, and they won't let our dairy imports go into the country.
Yeah.
So at some point, the U.S. is going to have to decide whether they care more about the dairy compacts or whether global security matters a little bit more, right? Like if they want to have reliable partners in the Pacific, they can't tell us to piss off whenever we come wanting to trade.
Yeah. What have the events, the weather events of this year, taught us about our climate resilience or lack thereof, and what kind of risks does that mean?
I think it's opened up quite a few issues. We've seen just how vulnerable we are. As a bank, we've been looking at rising sea levels and the impacts on our mortgage book in certain areas around the country. We've been doing this for 5 years. It's not new. Now we've realised that the water can come from up
sky,
up top as well. You can get hit by both sides. It is an awkward discussion. One that we're going to have with clients over time. I think it was AIG came out and said there were 20,000 New Zealand homes in very high-risk areas. A lot of those will have mortgages on them.
Yeah.
A lot of those will need insurance. As soon as you lose insurance or there's big exclusions, a bank's going to have to make a decision. Do we put a mortgage on that property? And I guarantee you some of the answers are going to be no. And it's going to be a very tough transition over that period. We're going to have to build our way out of it. Yeah. And we've shown we can't do it.
We've only got 5 minutes left, so I want to get to a couple of quick things that I think Eric's probably better positioned to answer. I know you've got some sustained concerns about the level of Crown expenditure. What have been the policy successes of the last 6 years?
Sure. March-April 2020 was a huge success. They rolled out the wage subsidy scheme in record time. It wasn't perfect, but if you remember the TV show MASH, they talk about meatball surgery. If you take the extra time to prevent a scar while somebody else is going to die because you haven't been able to attend to them, you do the best you can on short-term basis, and that was remarkable. The way that the ministries pulled together with government and others to make that all work. That was superb. National policy statement on urban development, excellent, enabling more development capacity in town. The medium density residential standards, superb, allowing more people to build, unlocking land value, right? At the same time, though, they've not allowed much building at the fringes, and you are still seeing a $1,300 per square meter price premium at Auckland's fringes for zoned land. That tells you that they've not zoned enough. But NPSUD and MDRS, superb.
What do you see changing if a national government comes in and pulls out of the MDRS?
Well, that's not so hot. So MDRS makes a lot... Okay. Both outcomes are going to suck. If Labour comes in, they will maintain the effective ban on new subdivisions. So if you look back to 2017, Phil Twyford was giving superb speeches on the need to allow cities to grow up and out, that you will never get housing affordability unless you allow both at the same time. They forgot the out part, and worse, they've told councils to consider carbon emissions in consenting, which all sounds good until you remember that every single urban emission is covered by the emissions trading scheme. So if you want fewer urban emissions, issue fewer ETS credits. That's the only thing that reduces net emissions. So they're not going to allow any further building at the fringes. And if the RM reform comes in, as they've promised, well, you're going to have a decade's worth of litigation while the courts figure out what Parliament thinks it intended in some of the vague phrases that they put into that legislation. So a decade worth of uncertainty of who's going to be allowed to build, but we know that you're not going to be allowed to build at the suburbs. If National comes in, they're going to let councils play silly buggers in development capacity. So they say, we want you to enable 30 years development all at once. Well, that's great. I'm a council, and I'm facing infrastructure funding and financing constraints and NIMBYs who don't like growth, and I'm seeing very few of the benefits of growth. Well, I say, I have zoned a 1 square kilometer area, or 1 cubic kilometer area. This is the cube. It can hold 50 billion people, right? They're all going to be in tiny apartments, and we have zoned this 1 cubic kilometer for massive density. Now leave us alone. Well, yeah, okay, that's an extreme example. That would obviously get fought back, but they're going to play silly bugger games on all of that, and then it'd be national fighting with them and how much they want to enforce it. On the downside, it looks like even Labour isn't willing to enforce MDRS on Christchurch. So nothing's great. It's your trade-offs.
I don't know that I've ever heard you say the opposite, that everything is great. Maybe one day. We've only got a couple of minutes left, so Jarrod, I'll finish with you. Can you give us, first of all, where you think the state of affairs will be in terms of the global economy 12 months from now? Where do you see things going?
Oh, look, I think things will get better, actually. I think we're going through this very awkward period now, but then we'll be in a situation where actually central banks will start reversing, start going the other way. So, we're expecting the Fed to start cutting from about March next year. RBA, RBNZ, all the major banks hopefully have broken the back of inflation. That's the key. That's the key bit. If if we're right there, then interest rates will be much lower next year, and you'll have a nice rebalancing that would have taken place, and growth starting to pick up over the second half of the year. So, if I'm thinking about us having this chat this time next year, unemployment rate will be higher, growth will be recovering, the housing market will have recovered, and we would have seen 5% gain in house prices. So I think a lot of awkwardness, a lot of toughness now, but there is light at the end of the tunnel should we break the inflation back and should central banks start cutting.
Where do you see unemployment peaking?
5.5%.
Right.
And that is just draw a line. Where we spend a lot of time on it as a bank, because unemployment is obviously correlated to defaults. Moving from 3% to 5.5%, we'll get a little bit of default action happening, not a lot. It's when it goes from 5.5 to 8, 9. There's this exponential relationship with defaults. So we're worried, about that upside all the time as a bank.
But there is reason to be optimistic, more broadly.
Yeah.
Yeah.
I think so.
Hey, thank you so much for your time. Please join me in thanking Jarrod, Crampton and Jarrod Kerr. Well done, guys.